You walk into a bank. You deposit 1,000 rupees. A week later, someone else walks out of that same bank with a 9,000 rupee loan. Pause there. How did one bank suddenly have 10,000 rupees connected to the same 1,000? That sounds like a magic trick. Or accounting with very expensive suits. Most people grow up with a simple idea. Banks take money from savers and give it to borrowers. Neat, sensible, almost comforting. There's just one problem. That is not really how modern banking works. And right now, that matters more than most people realize. Because when interest rates jump, when inflation bites, when housing gets harder to afford, when headlines talk about credit tightening, this hidden machine is sitting in the middle of it. Banks don't just move money around. In a very real way, they create most of the money we use. Not coins, not paper notes, the numbers in your account. The money that pays salaries, rent, food, school fees, and mortgages. That is where the story starts. Imagine a tiny town, one bakery, one mechanic, one teacher, and one bank. The baker wants to buy a new oven. It costs 100,000. He walks into the bank. Now, here's the part most people imagine. The bank opens a vault, takes out someone else's savings, and hands it over. But in modern banking, something stranger usually happens. The bank approves the loan. Then it types numbers into the baker's account. Balance, 100,000. That's it. No truck arrives, no vault door swings open, no pile of cash moves across the room. The bank has created a deposit. New money appears as a bank balance. At that exact moment, two things now exist. The baker has 100,000 in his account, and the baker owes the bank 100,000, an asset and a liability. One loan created one deposit. That sounds bizarre because we're taught money is something physical. But most money today is not physical. In many economies, physical cash is only a small slice of total money. The vast majority exists as digital bank deposits, numbers on ledgers, promises recorded in databases. That's the first uncomfortable truth. Most money is born when banks make loans. Now, you might be thinking, hold on, can banks just create infinite money? Not exactly, because banks live inside constraints, and those constraints are where things get interesting. Let's stay with the baker. He takes the 100,000 and pays the oven company. Now the oven company deposits that money into another bank. Suddenly, the first bank may need actual reserves to settle the payment between banks. Think of reserves as the plumbing underneath the visible money system. You don't usually see them, but banks need them to make payments to one another. So even though a bank can create deposits, it cannot ignore settlement. And it definitely cannot ignore risk. Because the real question is not, can the bank type numbers? The real question is, will the borrower pay it back? That changes everything. A bank does not create money because it feels generous. It creates money because it expects profit. Loans generate interest. That is the business. If a bank lends 100,000 at 10%, it expects more money back over time than it created in the first place. That spread is where the machine earns. And this is where things become slightly absurd. Banks create money first. Then they charge you for using it. Quietly elegant, or quietly strange. Depends which side of the desk you're sitting on. Now let's zoom out. Suppose thousands of banks are making thousands of loans every day. Home loans, business loans, car loans, credit lines. New loans create new deposits. More deposits mean more spending power in the economy. Businesses expand. Consumers buy. Asset prices rise. Growth feels good. This is why credit expansion often feels like prosperity, because it is money creation moving through society. But there's a second half to this story, and it is less comfortable. When loans are repaid, that money is largely destroyed. Let's say the baker earns revenue and pays back $20,000 of principal. That repayment reduces the loan, and the deposit used to pay it disappears from circulation. Money is created when banks lend. Money shrinks when debt is repaid. That means part of the money supply depends on debt continuing to exist. Read that again. A large part of modern money is linked to someone owing something. That creates tension, because economies like growth, but growth often depends on expanding credit, and expanding credit means expanding debt. That doesn't automatically mean disaster, but it does mean the system needs confidence. Now watch what happens when confidence breaks. A few years ago, central banks around the world pushed interest rates very low. Borrowing became cheap. Credit expanded fast. Property markets heated up. Tech valuations climbed. Businesses borrowed aggressively. Then inflation surged. Central banks raised rates fast. Suddenly, loans became expensive. Banks became cautious. Borrowers hesitated. Credit slowed. And when credit slows, something subtle happens. The creation of new money slows too. That matters because people often think inflation and recession are mysterious forces floating in the sky. Often, they are deeply connected to credit conditions inside the banking system. When banks lend more freely, money tends to expand.
When they pull back, the economy can tighten. Now here's where the popular story usually gets simplified too much. People say central banks print money. Sometimes they do create reserves. That is true. But most everyday money used by households and businesses usually comes from commercial bank lending. That's a huge difference. Central banks set conditions. Commercial banks make countless lending decisions inside those conditions. One controls the weather. The other decides whether to plant. That distinction matters, because it explains why low interest rates do not always produce a lending boom, and why money can feel scarce even when central banks are active. If banks think borrowers are risky, they pull back, and if households are scared, they borrow less. The machine slows. Now think about what this means for ordinary life. Why do house prices often surge when credit is easy? Because more purchasing power chases the same homes. Why do recessions often hit after lending tightens? Because spending power contracts. Why can healthy businesses suddenly struggle? Because access to credit can disappear faster than customers. Money is not just cash in your wallet. It is confidence, credit, repayment, and expectations stitched together. And the strange part is how invisible it feels. You check your balance. You see a number. It feels solid, permanent, almost physical. But behind that number is a chain of promises. A borrower promises to repay. A bank promises to honor deposits. Other banks settle payments. Central banks backstop liquidity. And society agrees the whole thing works. That agreement is incredibly powerful and incredibly fragile. History has shown what happens when people stop believing. Banks can survive many things. They do not survive a collapse of confidence very well. That's why banking crises spread so fast. Not because vaults suddenly become empty, because trust suddenly does. So here we are. The money in your account may not have been sitting there waiting. It may have been created when somebody signed a loan document. That loan may have helped build a bakery, a factory, a home, or a startup. Or it may have inflated prices, encouraged risk, and pushed more debt into the future. Same mechanism, different outcomes. And that leaves one uncomfortable question. If most money is created when banks make debt, what happens when the world wants less debt but still expects growth?